You probably know a guy who finally figured it out. He's in his mid-30s or early 40s. He stopped chasing every new gadget, cut the high-interest clutter out of his life, and started playing a different game. He pays his bills on time. He keeps a solid buffer in his checking account. He's not rich, not flashy, and definitely not reckless. He's just a man who decided he was done living one car transmission failure away from a midlife crisis. On paper, he is the American dream. He is the ideal citizen. But have you ever noticed what happens to a man like that? As he becomes more stable, the system starts to treat him with a strange, quiet coldness. The aggressive, pre-approved credit offers stop hitting his mailbox. The bank stops calling him with exclusive loan opportunities. The perks that were once showered on him when he was struggling suddenly vanish. And the truth is, this isn't an accident. It's math. Something quiet is happening to the men who get their finances right. The more secure you become, the less welcome you are in the machine. There is a hidden line, a specific financial threshold, where you stop being a customer and start becoming a problem. For most of you, that number is $50,000. Most people spend their entire lives trying to reach that milestone, thinking it's the doorway to being a preferred customer. They couldn't be more wrong. The moment you have $50,000 in liquid cash, you have entered the dead zone. You've reached the point where you have achieved the one thing the banking system cannot monetize: options. Think of the financial system like a high-performance engine. An engine requires friction to create heat, and heat is what generates power. In the world of banking, friction is your stress. The system works best when your balances are tight, your decisions are rushed, and your mistakes are expensive. When you have $50,000 sitting in an account, the friction disappears. The engine loses its heat. And once you see that, you'll realize that the banking system isn't designed to help you reach stability. It's designed to profit from your instability. The deadbeat revelation. Inside the walls of the world's largest banks, they have a specific word for men who pay their bills in full and keep their savings high. They don't call them success stories. They don't call them valued partners. They call them deadbeats. Think about the irony of that. In everyday life, a deadbeat is someone who is unreliable, someone who dodges their obligations. But in the upside-down world of high finance, a deadbeat is the man who is too reliable. You use the credit card for the gas points. You use the high-speed app to track your spending. You use their fraud protection to stay safe. And then, at the end of the month, you pay the balance to zero. You never pay a cent in interest. You never trigger a late fee. You never carry a balance. To the bank, you are a freeloader. You are using their billion-dollar infrastructure, the satellites, the encryption, the marble-floored branches, and you aren't paying a dime in rent. The industry splits the world into two camps: transactors and revolvers. Transactors are the deadbeats. They move money through the system without letting the system take a bite. Revolvers, on the other hand, are the people the entire model is built around. They are the ones who carry the balance, month after month, year after year. Which side do you think you're on right now? If you're still reaching for that 5-figure mark, you might still be a valuable target. But once you cross it, you become an overhead cost. You've stopped being a customer and started being a ghost in their revenue model. Being good with money doesn't make you a better customer. It makes you a liability. The 72% trap. To understand why a real buffer is a threat, you have to look at where the money actually comes from. Imagine two men standing at a grocery store checkout. The first man swipes his card for $200 worth of groceries. He's $50 short because his daughter's school fees hit earlier than expected. He'll carry that $200 balance for 3 months at 24% interest. The second man swipes the exact same card for the same groceries, but he has $50,000 in a high-yield account. He pays the card off before he even leaves the parking lot. On the surface, they look the same. To the bank, they are worlds apart. Roughly half of all credit card users in America pay their balance in full. The other half carry a balance. You'd think the profit is split 50-50. It's not even close. Banks publish this in internal profitability reports. The heavy revolvers, the people living under constant pressure, pay about 72% of all credit card interest in this country. The deadbeats who pay in full? They contribute less than 1%. Not 10%. Not 5%. Less than 1. Banks track this data with the precision of a heat-seeking missile. They know that if they lose the responsible customers, their business model barely flinches. But if they lose the men who are skating close to zero, the men who need the credit to survive the month, the entire system collapses. This is why the system feels upside down. It's because the customers doing everything right are financially invisible, while the customers under the most pressure are quietly carrying the entire machine on their backs. The question you have to ask yourself is, why would a system built on that math ever want you to be stable? The profitable crisis. The most profitable bank customers aren't the wealthy. They're the ones who are just one bad day away from a disaster. Think about a common Tuesday afternoon. A pipe bursts in the basement. It's a $3,000 fix. For a man with $500 in his checking account, that burst pipe isn't just a plumbing issue, it's a financial emergency. He has to scramble. He looks at a high-interest personal loan, or he swipes a credit card he can't pay off. He's forced into a decision because he has no margin. From the bank's perspective, that burst pipe just created a product. The interest, the fees, the long-term debt, it's all profit sparked by a moment of panic. Now imagine the same Tuesday for the man with a 5-figure fortress. He calls the plumber. He writes the check. He goes back to work. To the bank, that's a tragedy. A $3,000 opportunity just evaporated into thin air. No interest was charged. No fees were collected. The product never activated. This is the uncomfortable truth. Your financial strain isn't a side effect of the banking system. It is the fuel. Banks don't make much when money stays still. They make money when gaps close quickly and obligations expand to match your income. A man with debt is noisy. He's constantly interacting with the system, triggering fees and clicking on relief offers. A man with a serious buffer is silent. And in this industry, silence makes no money. The turning point. Every man who reaches for stability eventually hits a crossroads. You finally get that promotion. Or maybe a tax refund hits. Or you finally finish paying off that truck. Suddenly, for the first time in years, there's extra room at the end of the month. You have a choice to make. Which way do you usually go? Most people move toward the upgrade. A nicer car payment, a few lifestyle adjustments that feel reasonable. The extra margin disappears, the pressure returns, and the system lets out a sigh of relief. You're back in the game. You're monetizable again. But then there's the quieter response. You don't rush to fill the space. You let the calm last. You let that extra money sit in the account until it starts to pile up. 10,000, 20,000, 50,000. The system is watching how fast you refill that space. If you don't fill it with debt or spending, you are performing an act of structural defiance. You are choosing stillness over motion. To the bank, you've become the worst kind of customer, the one who never panics. The liability of stillness. There's a common myth that banks love it when you save money. You've been told that your deposits are the lifeblood of the economy. But look at the math from the bank's side of the desk. When you have a serious emergency fund sitting in a liquid savings account, you have created a series of obligations for the bank. They have to pay for FDIC insurance to protect that balance. They have to hold reserves. They have to pay for the digital infrastructure and compliance to keep it safe. And in return, what are they getting from you? No overdraft fees, no late penalties, no credit card interest. You aren't paying rent on the infrastructure you're using. From a cold profit and loss standpoint, a man with a large, quiet savings account is an expensive customer to keep. This is why the moment you stop carrying balances, the VIP treatment starts to fade. The phone calls from personal bankers stop. They realized they can't harvest you anymore. The system isn't built to store your money. It's built to move it under pressure. When your money sits still, the model stalls. The broke tax in real time. Have you ever noticed that it's actually more expensive to have less money? For the man living under financial pressure, the broke tax is a daily reality. Think about a simple car loan. If you have no savings and a mediocre credit score, you might be offered a rate of 18% on a used truck. You take it because you need to get to work. Over 5 years, you'll pay thousands of dollars in interest, money that could have been your own savings, just to have the privilege of driving to your job. Now look at the man with $50,000. He doesn't need the 18% loan. He can walk into the dealership and negotiate from a position of absolute power. He can say no. He can walk away. And because he can walk away, they offer him their best terms. The system charges the most to those who can afford it the least. It's not a punishment. It's a pricing model based on your lack of options. For a financially stable household, the cost of accessing their own money is about 1% of their income. For a financially vulnerable household, that cost can jump to nearly 17%. Over a lifetime, this difference quietly costs the average stressed household more than the price of a home. That is the extraction. That is the cost of not having a buffer. Every fee you avoid is a direct hit to the system's bottom line. And once you cross that threshold, those hits start adding up. You've effectively opted out of the broke tax for good. The war for your attention. Have you ever noticed that banks spend tens of billions of dollars on advertising, but almost none of it is spent encouraging you to be stable? Flip through any magazine or scroll through your feed. You'll see ads for credit cards with sleek metal finishes and premium lounge access. You'll see buy now, pay later offers at every digital checkout, promising you the world for just 4 easy payments. You'll see balance transfer promotions that look like an escape hatch from the debt you already have. But when was the last time a bank ran a Super Bowl ad about the psychological peace of mind that comes with a 6-month emergency fund? They don't. Because there is a simple mathematical reason for their silence. Credit products generate returns that are several times higher than any other service they offer. A bank might pay you a few percentage points on your savings, and even that feels like they're doing you a favor. But then they turn around and charge 24% or more on revolving balances. That 20% gap is the business. The system doesn't want customers who are settled. It wants customers who stay just uncomfortable enough to keep borrowing. This is why, the moment you move $50,000 from a low-yield checking account into a high-yield savings account or a brokerage, the outreach from your bank changes. Suddenly, the emails get more aggressive. The limited-time loan offers get louder. They can feel the money leaking out of their reach. When your money stops circulating through their high-interest products, the engine loses its fuel. Debt creates motion. Motion creates profit. Stillness creates nothing for them. And $50,000 is the ultimate form of financial stillness. The power shift. Something fundamental changes inside a man's mind when he has $50,000 in a liquid account. It isn't about luxury. It isn't about buying a boat or a Rolex. It is about the absolute shift in leverage. Think about a man at a job he hates. If he has $500 in his account, he has to take the disrespect. He has to stay late, endure the bad management, and keep his mouth shut. He is a price taker in his own life. He is negotiating from a position of biological survival. But look at the man with $50,000. He still works hard. He still shows up. But the desperation is gone. He knows that if things go sideways tomorrow, he has 2 years of breathing room. He can say no to a bad deal. He can walk away from a toxic environment. When you aren't forced to say yes to survive, your value in the marketplace actually goes up. Prices soften. Terms improve. The system starts trying to win you back, but by then, you've already outgrown the need for their approval. This shows up in the quiet wins. A car repair that doesn't trigger a credit card application. A medical bill that doesn't turn into a multi-year payment plan. A job transition that happens on your timeline, not the bank's. You are avoiding fees that never even appear on a statement, but they are the fees that fund the bank's quarterly growth. The power isn't the number itself. It's the silence it buys you. The two-class system. By now, the pattern is clear. The banking system doesn't reward your stability. It prices around your instability. We live in a two-class financial world. In the first class, customers pay constantly. They are the revolvers. They pay interest every month. They pay overdrafts when their timing slips. They pay the broke tax on every purchase. Their accounts are high velocity and high stress. And that stress is what keeps the money moving. In the second class, the movement stops. This is the class of the deadbeat. Bills clear. Balances reset to zero. Emergencies are absorbed instead of financed. From the outside, nothing looks dramatic. But from the inside, the bank has lost its grip. This split explains why you feel a strange sense of frustration when dealing with your bank as you get more successful. It's why they chase you when you want to borrow, but ignore you when you want to save. Having $50,000 pushes you firmly into that second class. You aren't special to the bank. You are just difficult to extract from. You've opted out of the minimum payment treadmill. You've rejected the penalty pricing disguised as convenience. Banks still call you a customer, but internally, you've been categorized as low yield and low priority. And that is exactly where you want to be. Becoming the customer they hate. The goal was never to win the bank's Customer of the Year award. The goal was to stop being useful to their fee model. In a system built on the heat of friction, opting out looks like boredom. And boredom is what freedom actually feels like. Becoming the customer they hate doesn't happen by accident. It happens through the boring, disciplined decisions that remove the bank's leverage over your life. It starts with the buffer. Every dollar you put away is a defensive weapon. It's a refusal to let the system profit off your future mistakes. Then, there is the refusal to subsidize. Moving your money to a high-yield account where you get paid, rather than leaving it in a big bank checking account where they get a free loan, is an act of structural defiance. Finally, there is the shift in identity. You stop seeing credit as a tool and start seeing it as a trap that only activates when you are weak. You use their cards for the points, you take their rewards, and you never give them a single cent in interest. You don't need to beat the system. You don't need to outsmart the bankers. You just need to stop supplying the conditions they profit from. When you do, you become predictable. You become quiet. You become unremarkable. From their perspective, that is a failure of the business model. From yours, it is the ultimate form of control. The signal of success. The takeaway is simple. Banks don't fail to reward stability by accident. Their entire model is built on pressure. Fees, interest, and penalties only function when money is tight and decisions are rushed. Once that pressure disappears, the system loses its teeth. Real savings don't make your life flashy, they make it quiet. Emergencies stop becoming products. Mistakes stop compounding. Options replace urgency. And without urgency, the traps simply stop activating. This is why financial stability often feels invisible. There is no applause for the interest you didn't pay. There are no rewards for the overdraft you avoided. But invisibility is the signal that you've won. You have moved out of the category that funds the machine and into the category it barely notices. The goal was never to impress the bank. It was to create enough margin that the system can't extract your life force anymore. In a model powered by stress, remaining calm isn't just a lifestyle choice, it is structural independence.